please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome back. Well, markets at this point in time not giving you too much of a direction. The early morning green got sold into and the red got bought a bit. So we are kind of even-steven at this point in time, a fairly stable tug of war between the bulls and the bears. But clearly in the Nifty Bank, it's the bears that are winning out, at least as of now. Barring Yes Bank, I don't think any major bank in the index is in the green. That's where things stand as of now. The advance declines are, however, in favor of the advances because of the 0.3% gain that you are seeing in the mid-cap index. So that's a bit of construction companies, some banks, a bunch of PSU banks doing well, and IRB infra stocks which are specific news-driven. One of the stocks that's been catching the eye and doing outperforming has been Zee Entertainment. Sonal, our researcher who tracks this sector very closely, is with us. Sonal, what's sticking for Zee Entertainment?
Well, actually, Lata, there's a Kotak report today on Zee Entertainment, and that's why the stock is buzzing in trade. The report says that Zee Network's viewership in Q4 was up around 21%, 230 basis points year-on-year at 26.3%, though the performance was very flattish sequentially, but on a year-on-year growth looks really positive for the company. And they also expect Zee to deliver 21% ad revenue growth, that is 700 basis points higher than the industry growth. And Sun Network, that is the closest peer to Zee, they saw some decline in their TV viewership, and that was majorly due to share loss to new competitors. Also, they are very bullish on the TV industry as a whole. They think that the TV industry will be able to grow with ad revenues of around 13 to 15% year-on-year, and they expect Zee Entertainment particularly to outperform the industry performance. And they have an ad rating on Zee with a target price of about 625 rupees. In terms of valuations, Sun TV is cheaper than Zee. Zee trades at around 33 times FY19 EPS, while Sun trades at around 25 times FY19 EPS. But going forward, they expect this valuation gap to reduce and Zee to outperform Sun TV. Back to you.
Okay, well, that's interesting. Thanks a lot for that, Sonal. But moving on, the earnings season is upon us, and the sector that we're looking at this morning is pharmaceuticals. So first, Ekta is here to tell us what to expect from the pharma space this quarter, and then we'll get another research or another analyst to tell us his expectations. Ekta, go ahead.
Well, it's expected to be another muted quarter for pharmaceutical companies in Q4 of FY18. Now, for the US markets, it's expected to decline for the 5th consecutive quarter with a decline of around 1 to 3% on a year-on-year basis, primarily due to the pricing pressure which continues to plague the US markets. However, some companies such as Cadila and Natco are likely to benefit from a strong flu season and the drugs such as Tamiflu that they're selling in the US markets. Domestic markets likely to be stable with up to a 10% growth this time round. Margins are likely to be similar to the previous quarter, and again commentary would be very important. One, in terms of what FY19 is looking like, and two, what the regulatory status of many of the plants of pharma companies are currently.
Thank you very much for that, for putting all the themes in place, Ekta. But now to take it forward and break it down to stocks, Amey Chalke of HDFC Securities joins us to discuss their expectations from the pharma space. Amey, thank you very much for dropping in into our studio. Well, I think the biggies are all going to report poor earnings this time.
Yeah.
Let us start with the good news. Is there anything that will stand out, any Aurobindo or anything that will perform in terms of earnings?
So obviously Cadila is doing well,
okay,
because of two big product launches which had happened in second quarter of FY18, which is Lialda and Tamiflu. So, however, sequentially, there would be some decline on the top line and margin could decline a bit. However, the year-on-year performance would be quite strong for Cadila.
Okay, so that's on Cadila. Amey, hi, good morning. I have to ask you about Divi's Labs because, you know, that stock has made such a comeback. I mean, it was down in the dumps less than 12 months ago and now it's doubled since then. This time earnings, you think, expected to be good, and how are you positioned there?
So Divi's Lab is a CRAMS business model. So this fourth quarter is typically a seasonally strong quarter for all the CRAMS companies. So we expect good pickup over there. So we expect 1,100 crore kind of a top line, and margins are likely to be better sequentially because there would be low remediation cost involved in this quarter. So it should go down. So margin should improve to 34.5% types.
But would you still buy it at this, or would you advise buying it at this price?
Well, a long-term, CRAMS business models have good future. So obviously, being a leader in the industry, obviously we have positive stance on the DVs. However, on the valuation front, it is quite expensive, so we have maintained neutral on the stock at this point.
Okay, actually, so among the big stocks, it's only Cadila that's going good for you. Among the mid caps, it's Divi's. But you also have a kind word to say on Torrent Pharma and Jubilant Life.
Yes, so Torrent, I guess last quarter they reported 24% EBITDA margins.
Oh, I see.
So which was significant improvement over first two quarters. So after merging with Unicam, basically after acquiring Unicam business, I guess they should report good profitability going ahead, basically, and that will. If they continue to report 24% plus EBITDA margin going ahead, I sense that there could be a re-rating happening in the Torrent.
Okay. Well, I know we are talking about earnings, but because, you know, the stock is in the news, I have to ask you about Fortis. Do you track the deal that's underway? I mean, there's a fourth player now in the fray.
So it's we don't track Fortis. We don't track hospital segment at this point of time.
Okay.
But any thoughts on the deal at all?
So I guess let's say how it plays out, but it is difficult. There is also litigation going on in the Supreme Court, so that the outcome is also awaited over there. Okay. So,
all right. So you steer clear of Pittles at this point in time. Well, I think Alkem is a stock you like. Now, you know, while you did speak positively about Divi's as well as Torrent, these stocks have also run up a bit. So is it still worth buying? Both
no,
these stocks,
Alkem has corrected significantly.
Alkem has corrected.
So from 2,200 to 400 levels, it has gone down to 1,700 level, I guess. And that is on account of 483 for the Daman plant.
Okay.
However, on earnings contribution, US doesn't contribute much for Alkem. So we believe this is a good time to start buying Alkem at this price. Because if you value their only domestic business, then 1,700 is the right price to enter, basically.
Even Torrent, I think, has not moved much this year.
No.
Is there still space you think it's worth buying?
Yes. So that's what I told you, that if it again reports 24% kind of EBITDA margin, and if management gives confidence to the investor that they will maintain the EBITDA margin going ahead, considering that Unicam is also a profitable business, it's kind of a cash cow branch which are there. So if they maintain that trajectory, obviously there is good run-up expected in the Torrent.
Okay, so just give us your top buys and your top sells now.
So in large cap, although we are very cautious on large caps, we still have Cadila as a buy because there is no regulatory issues. All complex generic products they have filed. In mid cap, we have Alkem as a strong buy, and because of domestic focused company and having outperformed the domestic market for last 10 years. Then Dishman Pharma, which is a CRAMS business model, which is also a secular business model, not going to be affected by the US drug pricing at this point of time.
Okay. Well, fair enough. Thank you very much, Amit Chalke, for dropping in our studio and preparing us for the earnings season. Don't expect too much from the big boys, Sun, Lupin, Reddy's, but maybe Cadila, the one that's free from, admonishing from drug authorities, could be a positive surprise. But watch out for Torrent Pharma if it can repeat that 20% plus growth. Okay, not much growth as far as prices are concerned at this point in time in the markets, except for a clutch of mid-caps, and mid-cap IT is among them. Probably the trend will be set by Mindtree, which will announce its numbers. So I think it's good that we remind you of what the street is expecting from the Q4 numbers. A dollar revenue growth of 4% is expected. Is it, Rima? Tell us all the expectations.
Well, the stock is at a record high. It's seen a big outperformance. It's outperformed the Nifty IT index by close to about 30%. And with that, it's trading at premium valuations. Its F520 PE is close to about 19 to 20 times versus an historical average of only 15 times. As you rightly pointed out, the dollar revenue growth is seen at about 4%. The company itself had set expectations. In their Q3 conference call, they indicated that growth in the March quarter will be similar to Q2 and Q3, which is a range of about 3 to 4%. They also added that margins will be flat sequentially. So in Q3, EBITDA margins were at 15.1%, and that should be the picture this time as well. And profits, according to our poll, should be higher by 4% on a quarter-on-quarter basis. The key reason for this optimism on Mindtree, one was a very strong performance in Q3, a big beat compared to expectations, which is what drove the re-rating. But even other factors like the issues they faced with their large clients seem to be behind them, because the company delivered strong growth in their top accounts in Q3. Their margins have been improving after crunching down in FY17. So in the last 2 quarters, margins have improved by 400 basis points. Their digital portfolio is 44% of their revenues and growing well. What the street wants to see is an improvement in their new deal wins, because the new deal wins didn't pick up in the last few quarters or improved on a sequential basis. So that is something which will be tracked. And the management does not give you a quantitative guidance, but up until now they've said that growth is usually better than industry leading. It will be better than NASSCOM. It could be a double-digit growth. So some outlook from the management on the FY19 revenues and margins will be closely tracked.